What's going on, guys? Matt in the hat, Keller Williams Diamond Partners. You are tuned in to the hot list. I come to y'all each and every week, and we talk about properties that are listed by myself or my brokerage. And I also answer a question of the week that is submitted by you, the listeners. And I really enjoy doing this because it allows me to reach out and get in front of more people, answer more questions. Make sure you keep those questions coming, because if you have that question about real estate, the chance that somebody else has that question or same question or similar question is very strong. So by you submitting that question, I can not only answer it for you, I'm also able to create future episodes just like this one to help more people get those questions answered and give them a direction of where they can start and what rabbit hole they can go down for. They can go down to look for. So this is episode number 273. Again, I'm your host, Matt Johnson with Keller Williams Diamond Partners. I greatly appreciate you spending your time with me, and make sure that if you have a question, there is a Google form now in the details section below. And all you have to do is type in your email address, type in your question. I will get that answered for you. And then that gives me future content for just like this one. And if you're not sure where to start with your real estate question, I would love to be the real estate resource that you start with and reach out to and give you somewhere to begin. So with it being the spring market again, things are starting to pick up. More and more people are starting to reach out to me and say, "Hey, what do I need to do to get pre-approved?" And that also comes along with what type of loan do I qualify for? So, and these are going to kind of go hand in hand. So to answer this week's question of how do I get pre-approved, we're going to jump in and discuss 5 things that you need to know for a pre-approval. Now, before I get into that, before we get too far, if you're not familiar with the home buying process, choosing a loan that meets your needs or you qualify for can be one of the hardest parts of buying a home. There are several mortgage options out there, and if you choose one that isn't ideal for your current situation, you could end up paying more in the long run. And that brings up another question. Where do you start? How do you start? What is the process like? While it might take a little bit of homework and some actual talking to lenders, this is going to be a great way to see which lender you feel comfortable with, that you have some rapport with, and find out a little bit about the types of loans that are out there and that you potentially qualify for. There are a few things that may affect your loan, such as where you live, your credit score, credit history, as well as the state of the economy, which, we're not going to get into that. So in this episode, we're going to talk about 5 things needed for a pre-approval. Like I mentioned, before we get down that rabbit hole a little too far and get into it, I do want to remind everybody of a couple items. The first one is there is a difference between a pre-qualification and a pre-approval. A pre-qualification is an estimate of how much you could afford to spend on a home. This is not done with the lender. This is something you can do in the comfort of your own home, going online, playing with the mortgage calculator and seeing, you know, how much you make and just playing with it that way. A pre-approval is through a lender, is valid for 60 to 90 days depending on the lender, and it requires you to meet with said lender to discuss loan options. They will also run credit history, confirm employment, and W-2s. And for the requirements of the pre-approval, which we are going to get into today, it requires the buyer or borrower, to complete a mortgage application, proof of assets, confirmation of income, a minimum credit score depending on the loan type, and employment verification. Your pre-approval is going to be based on your FICO credit score, your debt to income ratio, and some other factors varying by loan type. So, 5 things needed for a pre-approval. Number 1 is going to be proof of income. This is where borrowers must provide either a W-2 or 1099 statement and tax returns for 2 years. And that's going to be standard with lenders, especially if you are a 1099. They are definitely going to want 2 years worth of tax returns. You can also submit your current pay stub and maybe asked to provide, as long as it's on there, it can show your year-to-date income. You also have to disclose other income sources such as child support, alimony, disability, etc. So when you fill out that application, all of those are going to have to be taken into take that into account and go from there. Number 2, proof of assets. This proves that borrowers have funds for the required down payment, inspections, closing costs, as well as cash reserves. And this just makes sure that you have enough money to go through the process. Now, there are programs out there for like down payment assistance, home buyer programs. So talk to your lender. It will vary by state, where you live, and what if the lender participates in that. Now, unless you are a veteran or service member applying for a VA loan, then that the down payment isn't going to be a factor, but they still will make sure that you have the money for inspections and cash reserves. They do figure out the down payment because it's based on a percentage of the selling price. This will, of course, vary by loan type. Most of the time you hear with conventional loan, it's 20% down. That's not necessarily the case anymore. There are some that have some flexibility with that. And the FHA loan is typically 3.5%. And these are a lot of times minimum requirements. You do have the ability to put down more if you would like. For most lenders, if you are not putting down 20%, there is something that they call PMI, which is private mortgage insurance. This will vary by lender, but most of them will require some type of PMI included in the loan if you're not putting 20% down. So just make sure that you talk to your lender and ask questions. I mean, if you don't understand something, make sure that you are asking questions to the extent that you fully understand what the lender is talking about. Number 3 is good credit. Most lenders will require a minimum FICO score of 580 for a FHA or VA loan and 620 for a conventional loan. There are lenders out there that do have better rates for borrowers that have a 760 plus credit score. So if you're not sure what your credit score is and you're considering either buying your first home or upgrading from your current home to the next one, it's never too soon to speak with a lender because they can give you some advice on and let you know where you're standing right now. And if you do some work on these areas, you're this close to, the next approval for whatever loan type. So that may be something to consider is put it on hold for 6 months, 12 months, and try to jump that credit score up a little bit. That's only going to save you down the road. And just a reminder, I kind of already mentioned it earlier, but there are mortgage rate calculators and interest rate tools available online that can kind of give you what um, maybe the payment range based on the dollar amount, the down payment, interest rate, and the loan length. And you can play with this if you have better credit. Obviously, the interest rate will be a little bit lower, but if you just start at what the average interest rate is, that's going to give you at least somewhat of an idea what you're going to be looking at and expecting. Number 4 is employment verification. Recently, lenders not only verify the employment with pay stubs that are provided to them, they a lot of them will now contact the employer to confirm your employment as well as your salary. And for my fellow 1099ers out there, the independent contractors such as myself, be prepared to provide additional information such as the stability of your income, location and nature of your business. You may also be asked to uh, provide the financial strength of your business and the ability of your business to continue to generate income. Man, I'm struggling. Words are hard. And with that last one, to show the ability to continue to generate income, this is going to show that you as a borrower have the ability to continue to make those mortgage payments. And finally, number 5, other documentation. Personal docs and IDs are going to be required, not just for the pre-approval, but when you get to the closing table as well. They will require at least 2 forms of ID. One will need to be a picture ID, whether it is a driver's license or state issued ID. And the second one can be something for lenders. It will be your social security card. That way they can verify and then pull a credit report for you. Once you get to the closing table with either attorneys or title companies, they will generally require 2 forms of ID, which again would be a picture ID and then something that has your name on it so they can verify that you are who you say you are with 2 forms of ID. So now that we've covered those, what happens after the pre-approval? What do you do next? So in this situation, lenders are required to provide a document called the loan estimate, and they have to provide this within 3 days that you complete a loan application. This is going to outline the pre-approval amount. It may even have a max loan amount on there. Again, varies by lender, but it's going to outline the terms and the type of your mortgage, the interest rate, estimated interest, as well as payments. There also may, if not, ask for it. There should be an estimated closing costs on there, estimated property taxes, as well as homeowners insurance. All of those are going to be part of the closing costs that's going to be collected. So make sure that you know what those estimates are before you get to the closing table. After that, the loan is going to be submitted to an underwriter, And this is to ensure that you, the borrower, meet guidelines for whatever the specific loan type that you applied for is. This will determine your approval. As long as nothing has changed your on the borrower's financials, the loan can move forward to closing. But for example, if you are you're excited because you got the pre-approval, you found a house, you've got through inspections, you're headed to closing, and a week before closing, you decide that you need new furniture, and you go to a here is Nebraska Furniture Mart. You go there, apply for a credit card because you don't want to take away from your down payment money. You get approved for the credit card. You get a couch, you get a love seat, you get a coffee table, you get a dining room set, you get lamps, you get decorative pillows, maybe even a new washer dryer. Now all of that has affected negatively your credit score. So when it's submitted to underwriting, your credit score has now changed and which means you may be below the cutoff for the minimum requirements and you may no longer qualify for that loan. So listen to your lender, listen to your agent. Do not do anything during the home buying process that will affect your credit score. Don't apply for any new cards. Don't spend any money on credit cards. Don't change jobs. All of this could potentially affect your ability to close on that property and on that loan. So please make sure that you don't do that and just listen to your lender and your agent. Now on the other side of that, what happens if you don't get approved for a loan? So what's going to happen after you fill out the loan application? It's going to be reviewed by the lender and the decision will be made to approve, deny, or approve with conditions. If it is approved with conditions, the borrower may be asked to provide additional documentation to remove those conditions or pay off existing debt to meet certain guidelines to get approved for that loan. If you are denied, the lender will explain why and go over that with you. And they should also offer options of what to do in order to improve the chance for a pre-approval, whether that is in 6 months or 12 months. So make sure that you ask those questions. So those are the 5 things needed for a pre-approval. Just to reiterate from my disclaimer here, this is not an exhaustive list of everything involved. This is just a quick top 5 things that are going to be needed to get you started. This is going to vary by lender, by loan type, by location. So make sure that you talk to a lender. In my opinion, it's never too soon to speak with a lender and know where you stand, what you can work on, or whether or not you're good to go. So that's my 2 cents on that. While things have been complicated over the last 3 years, lenders have had to adapt. So they there's going to be more documents required, and there's reason for that. So pick a lender that isn't just an order taker. You can talk to more than one lender. Just make sure not every lender is running your credit. Before they run your credit and you go for that pre-approval, talk with them, have a conversation. Find a lender that you have some good rapport with, you feel like is going to treat you right and be an advisor, not just an order taker. So that is going to wrap up the podcast for today. And for this week, thank you guys so much for tuning in, listening. Please make sure you leave a review on iTunes or Spotify or whatever podcast player that you are listening to this. I greatly appreciate that. That allows me to get in front of more people, help more people just like you listening to this. Also, if you are watching this on YouTube, make sure you do the YouTube things, helps the algorithm and helps me get in front of more people as well. So thank you guys so much for tuning in and hanging out. Again, I'm your host, Matt Johnson with Keller Williams Diamond Partners. I do this because your experience matters and should be trusted with a veteran. Y'all have a phenomenal week, and I'll see you next week. Take care.